Hello everyone, thanks for checking out my video. I have hit 1000 subscribers. Just wanna say a big thank you to all of you who have supported the channel by watching, liking and subscribing. Anyway, the stock market sold off last week after Jerome Powell came out to spook the market with his hawkish tone. The various big tech stocks were looking really weak, with Tesla plunging more than 15%, marking its worst weekly performance this year. Nvidia fell by about 8% and other big tech stocks declined for the week as well. More importantly, the S&P 500 technical chart is looking very bearish to me, which I will be covering in the technical analysis segment. So, are we expecting more sell-off and bloodbath in the week and weeks ahead? Let's discuss them in this video. Also, amid the chaos, I have picked up some shares and opened a new option trade, and I have a live recording of that option trade, so do stay tuned to find out more. Alright, there were lots of things going on last week. Powell's speech, rising treasury yields, Tesla's disappointing results, strong job report, and the list goes on. So I am just gonna focus on the key events that moved the market, at least in my opinion. The first one was none other than Jerome Powell's speech. To summarize his hawkish speech, he basically said that inflation is still too high and lower economic growth is likely needed to bring it down. In my view, the hawkish part was that he said he doesn't think the rates are too high right now. Does it feel like the policy is too tight right now? I would have to say no, that's what he said. I mean, at more than 5%, it's still not considered as high. Okay, he then signaled that the labor market and economic growth may need to slow to ultimately achieve the Fed's goal of 2% inflation. That's hawkish as well. In layman terms, it means we need to have higher unemployment rate, lower wage growth and weaker economy with lesser spendings. In my view, if this can be done in a contained manner, then yes, inflation could go down without huge impact to the economy and stock market. But if these go out of proportion, then we are talking about a recession all over again. The other key thing that I wanted to highlight is that the 10-year treasury yield hit 5% for the first time since July 2007. That's a good 16 years ago. So what does it mean for us? To explain in simple terms, it means high borrowing costs such as mortgages, student debt, auto loans and all these loans will go even higher. This may cause a ripple effect and has real impacts on the economy, as it will ultimately affect every individual in the US. As a result of this series of events, all three major indexes ended red last week, with Nasdaq dropping 3.2%, S&P 500 losing 2.4%, and Dow Jones slipping 1.6%. More importantly, the S&P 500, which represents the broader market, slipped below its 200-day moving average for the first time since March this year. More on that later in the technical analysis segment. This week, we have the largest and most influential tech companies reporting their earnings and giving their guidance for the company outlook. Their forecast will provide some insights on the health of the global economy and also the impact of the Fed's current monetary policy. The big guns who are reporting this week are Microsoft, Meta, Amazon and Alphabet aka Google. Other major companies reporting this week include Intel, MasterCard, Visa, Boeing, Coca-Cola, etc. The highlight of the week is actually the PCE data that is set to be released on 27 October Friday. With the earnings in full swing and this PCE inflation number coming in on Friday, which is an option expiration day, please expect volatility on that day. So if you are a short-term trader, just be a little bit more mindful, okay? Finally, I would think the whole world is also watching how the Israel-Hamas conflict unfolds in the weeks and even months ahead. And oh, do also watch how the yields move this week. If it breaks above 5% again and stays above it, it's bad news for the stock market. Alright, let's now look at the technical charts. SPY, which represents the broader market, is looking quite bearish. Can you see this green dotted uptrend channel? SPY broke below it, went back up to do a classic textbook retest and got rejected. This is bearish to me. And then we had 3 big red candles with 2 days of very high volume. That's confirmation of a bearish trend. Other bearish signs include the 50 moving average crosses below the 100 moving average, and also the MACD just had a bearish cross. Okay, just to give a disclaimer, I cannot accurately predict where is SPY headed this week or in the weeks ahead, but I personally am expecting SPY to test that recent low of 420.18 and may even break below it to create a new recent low. That's because I am of the view that the 200 moving average will be tested, which currently sits just below 420. Alright, here's the thing. Remember, I have talked about how important this 420 level is, and now that the 200 moving average is also at this level, it makes it even more crucial. Assuming every other investors and institutions are looking at this level, watch how SPY move when it tests this 419 to 420 level. Interestingly, we had a bounce the last time this 420 was tested, and we also went close last Friday. So if third time's a charm for the bears, they could succeed in bringing SPY below 420 this week, and that's when I think we will see a sea of fate in the market. Below 420, I really don't see much strong support. Honestly, I think if 200 moving average gets breached convincingly, we are looking at 415 and below. But well, market is unpredictable, so if somehow 420 and the 200 moving average hold this week, bulls have a few levels to clear before they can regain their bullish momentum, and these levels are 427 and 432. But before you get too excited, by clearing these two levels are not enough. It has to retest that green dotted uptrend channel and passes the test by going above it, which means above 436. That's also where the 50 moving average sits. If that happens, then yes, I would say bulls have regained some control. But to be frank, given the current market conditions, I think it's quite tough, unless the big tech giants all reported solid earnings. But what are the odds? I wouldn't bank on them right now. Next up, let's check out Apple. Apple is currently sitting at a very critical and dangerous spot. By now, you would probably know that the 61.8 Fibonacci retracement level is quite important, and Apple closed below it last Friday. Come early this week, if we don't go above it quickly, I personally think that the 200 moving average will be tested at around 169, which is really not too far away. Also, just to highlight, the MACD just turned bearish last Friday. And so, if we have a red candle on Monday or Tuesday, the bearish trend is likely to continue. If this 200 moving average gets breached, the last support is the recent low at around 167. And if both levels are broken, I think we can expect low 160s or even 150s range in the near term. In terms of the upside, Apple has to reclaim that 61.8 Fibonacci level as soon as possible, which is around 173. But even if it does that, the bearish trend is still intact. Staying above 173 is just preventing Apple from rotting further, and bulls would be hoping for sideways consolidation in the 170s range. Apple basically has to go above the 50 moving average at around 177.5, then we can say that it is slightly bullish. For full-blown bullish momentum, it needs to take out the recent high of 182, but it's really an uphill task at the moment. Alright, moving over to Tesla. I think one doesn't need to be a rocket scientist to be able to see that Tesla's chart is looking very bearish right now, as it fell more than 15% last week. The question now is, when will Tesla stop its rot, and how are we going to spot the pivotal point? Alright, let's dissect the chart. As you can see from the chart, Tesla was slicing through the various support levels like slicing tofu. Actually, I have warned the viewers in my last video that when Tesla wants to flush down, it can flush very fast. I also mentioned to watch for 250 level, and I said if that breaks, we could say hello to 240s and 230s. So last Wednesday, Tesla closed below the critical 250 level, at 242 to be exact. And what happened the next 2 days? Tesla plunged all the way to 210s range, more than what I expected. To stop the current rot, look out for one key signal, that is to reclaim the 200 moving average, which currently stands at 214. I was actually observing this level last Friday. During intraday, bulls kept trying to push it back up during the first half of the day, but in the end, bears prevailed as the selling pressure was too heavy for bulls to handle. Well, I think the saving grace for bulls is that the last 2 times when the RSI reached this very oversold level, we had a decent bounce. Let's say the bounce comes this week or maybe next week, don't be too excited yet, okay? Bulls have a long way to go before it can change the current bearish trend. I mean, we are talking about 230s range. So yeah, let's talk about the upside again when we fill the gap between 230 to 242. Anyway, before we move on, here's a thank you message. I wanted to take this opportunity to thank those who have followed along this YouTube journey of mine. I posted my very first video on 18 December 2021 and I finally got 1000 subscribers on 20th October 2023. That's about 1 year and 10 months. Relatively slow, but I guess it's up slowly but surely. By the way, just so you know, my channel is still not qualified for monetization yet. So I am still doing all this for free. I get paid nothing from YouTube for the last 1 year and 10 months. And it's still the same for now. And to be transparent, I will keep you guys updated when my channel gets monetized. So, meantime, if you like my free content and would like to support me, perhaps you can buy me a coffee via my coffee page. It's only gonna cost you $4. Not gonna make you poor, not gonna make me rich, but it does offer some form of encouragement for me. Thank you in advance. Alright, back to business. Meanwhile, if the market wants to continue to flush Tesla down, to be honest, I don't see much support all the way to the psychological level of 200. Therefore, if we don't reclaim the 200 moving average soon, I think there is a decent chance for Tesla to hit low 200s. If we go below 200, well, it will not look good. Can you see this consolidation zone here? The bottom of the zone is low 170 and you can even stretch it to the 160s range. Okay, just to be clear, I am not saying Tesla will flush towards this range soon. What I am trying to say is, once we get into this consolidation zone, it means there is room for downside all the way to 170s. Hopping over to Google's chart, in my last video I shared that the levels 139, 140 are pivotal area. So as you can see from the chart, Google tried to break above it on 4 out of 5 trading days last week, but couldn't succeed in doing so. As a result of the rejection, it fell to 135. If the bearish momentum continues this week, we can expect Google to hit the 50 moving average and the next Fibonacci retracement level at 134. This 134 level is quite special this week because this is where the Ichimoku cloud support is as well. So, with 3 support levels converging together, I would say it's one hell key level to watch. If you are a bull, you would want this area to hold. To also highlight, the MACD just had a bearish cross, and if the market doesn't like Google's earnings report and the triple support area gets broken, it would be very bearish for Google. That is when I believe we will hit towards low 130 or below. Below 130, the next support is 127. This level shouldn't be new to you because this is the bottom of this consolidation zone that I have been talking about for many months. On the upside, as what I have shared earlier is quite straightforward. We will just have to watch for that 139 to 140 area. So far, Google hasn't been able to stay above 140 for long. We need to put a few green candles above 140 to be bullish. So last Friday, 20th October, I opened a new option trade and I have a live recording of it which I am gonna show you later. Anyway, I sold a cash secure put on Tesla with a strike price of 175 and expiring on 24th November. This trade is a risky one because Tesla has been facing massive selling pressure recently, and as I have shared in my technical analysis, if Tesla wants to flush down, it can flush very quickly and can go down by a lot. This means the strike price can get breached anytime. So why did I still sell this Tesla put? Well, here are my thoughts. First of all, its share price has dropped close to 10% the next day after it reported a disappointing earnings result. In my view, that's overreaction, as with many other stocks after they reported their earnings. And if you were to add on the previous day's loss, that's close to 14% decline in just 2 days. Anyway, history has shown that Tesla has a chance for a minor bounce. Basically, its share has gained an average of 0.4% the day after post-earnings drop and have risen 7 times. Interestingly, 1 week after the huge decline, shares have risen an average of 1.4%. Next, as shared earlier on the RSI, Tesla is very oversold. And the last 2 times when it was at this level, we got a decent bounce. And then, can you see this Bollinger Band? Tesla fell completely out of it. typically a stock will go back into the band as time progresses. Again, this gives us another possibility to see a small bounce for Tesla. Moving on, Tesla was the top 5 shorted stocks one day after its post-earnings. In my view, these shorts will have to cover their positions eventually. I don't know when, but there is a possibility for it to happen in next 1 month. And that is also the reason why I usually prefer a longer dated option contract. Finally, as shared earlier, the 200 moving average, which sits at around 214, offers a massive support. And that was the reason why I stepped in at 215, where I not only sold this put contract, I have also picked up a small bit of its shares. But of course, a massive support doesn't mean it is a support that cannot be broken. And it did. It broke last Friday. This is very bearish for Tesla, and we could see waterfall if we do not reclaim this moving average. That is also why I said this is a risky trade, so please do not follow me blindly, okay? Anyway, to manage the risk, I chose a strike price that is quite far away at 175. At one point, I wanted to choose 180, which I thought is decent enough. But hey, it's Tesla. I mean, if we can get another week of massive decline, we could hit 180. Therefore, I chose 175 to give myself more buffer. Alright, so here's the live recording of the trade. Last Friday, Tesla was plunging and was very oversold. I went to the option page, select the expiration date that I want, 24th November. I then went to my desired strike price 175. Click on trade, and then I entered my password. Entered the quantity amount, clicked sell, continue, confirm, and order submitted. I waited for a little while, and 3, 2, 1, ordered failed. Next up, I have 3 cash secured puts that are expiring this week. All of them are in the green zone right now. If you recall, this Bank of America trade was super red at one point, but it managed to turn green last week. Anyway, I have to watch it quite closely this week as my strike price is $26. I must be prepared to close the position anytime if I do not want to get assigned. As for the other 2 trades on Microsoft and Google, I have shared my thought process previously. You can check out the video link at the top. And if you do not want to miss out on my trades, do subscribe to my channel to stay updated. Oh, one more thing, I have decided to offer my real option trades from 2022 for free as a token of appreciation for hitting 1000 subscribers. Nothing much, but if you are keen, you can download it for free on my Ko-fi page. Alright, the usual stuff, sharing some of my thoughts every week. At the moment, there are lots of things happening. High interest rate, ongoing wars, high use, etc. All these are easily at the back of my mind, and it could be on your mind too. Well, in my view, a lot of these are noises for long-term investors. We as long-term investors need to know when to declutter some of these news and noises. For short-term traders, we should embrace these noises because they create volatility, and it is good for options trading. And in case you are still not aware, I am mainly a long-term investor and a small-time player of short-term option trading. Even for my short-term trades, I'm talking about 1 month or so, not so much of a day trader or swing trader kind. So what I usually do is I will organize my mind and segregate the news or noises depending on which hat I am putting on, the long-term investor hat or the short-term trader hat. And this was the reason why I stepped in for Tesla at 215 last week. It actually closed below that price on Friday, but did I regret my action? Nope, I don't. Because I know I cannot pick the bottom of the price, and because these shares that I picked up is for my long-term portfolio. Well, yes, I mean Tesla could fall lower to below $200, but it's all about probability right now. I mean, what if it doesn't? Would I miss out on the upside then? Just like when Tesla was at low 100, a lot of people are calling for below 100, which didn't happen and Tesla shot up. Also, to manage my risk, I only dip my toes in a little bit, just in case Tesla decides to slide below $200, which I will then pick up more shares again. So that's the thinking hat of a long-term investor. As for short-term trader, I have shared my thought process in the option trading section, so do check it out if you have skipped that part. Overall, I am of the view that the stock market volatility will likely be around until the yields stabilize. If every other day we have the yields hitting 16-year high, it will be tough for the stock market to really settle down. Not to mention, high treasury yields also offer investors an attractive alternative to stocks. Just to add on, high treasury yields can really take a toll on the economy. Mortgage rates will stay high, student loans could get pricier, car loans are getting more expensive. All this will affect the economy and companies' earnings. Well, but there is always silver lining in everything. So in this type of environment, savers or cash hoarders can benefit. This is the rare time in recent history where cash looks pretty good. That is also why I have some cash in money market fund while waiting to pick up shares in the market, and also parking some cash in Singapore saving bonds and high interest savings account. All these are offering me decent daily and monthly returns. To the viewers out there, how are you deploying your cash right now? Are you buying shares amid the chaos in the market? Or are you holding cash by the sidelines to wait for things to stabilize? Or are you like me, doing both? Happy to hear from you in the comments section below. Alright, do remember to tap the like and subscribe buttons before you exit this video. Thank you.